So welcome back everyone to this next session, Investing in Nature. I'm Helen Avery, Head of Nature Programs at the Green Finance Institute, and it's a pleasure to be here this afternoon listening to these fascinating conversations. We just heard Siddhartha Dasgupta. For our panel for the next hour, I'm joined by 5 experts to continue this exciting conversation about how we start to move capital flows into nature positive outcomes. So I'd like to introduce them to you now before we dive in. We have Peter Young, Chair at ISO TC 322, Sustainable Finance Committee. Thanks for joining us, Peter. We're also joined by Paul O'Connor, Executive Director, Head of EMEA ESG Debt Capital Markets at JP Morgan. Thanks, Paul. Tashita Ranchen, Trustee at the Green Purposes Company. Thanks for joining us, Tashita. Simon Zadek, Chair of Finance for Biodiversity Initiative. Welcome, Simon. And Robert Alexandra Poujard, ESG Analyst and Biodiversity Lead at BNP Paribas Asset Management. Welcome, Robert. So a very warm welcome to you all also watching and listening. For the next 45 minutes or so, we're going to be discussing the question of how we move investments into nature. What does it look like? How can we make that happen? What challenges do we face? And then we'll open up to questions from you, our audience. But I do encourage you to post questions throughout the discussion. As if my multitasking skills allow, I will do my best to keep an eye on those and weave them in as we go along. So please do send in your questions. So to start, Peter, I'm going to come to you and welcome again. We just heard from Siddhartha Dasgupta that we have to urgently invest in nature. And we have a couple of things happening at once, it seems. There's this desire to shift to do no harm to nature when it comes to our global capital, where our global capital is invested. And then there's also this need to invest in nature protection, restoration, expansion, whether it's for biodiversity loss, but also climate mitigation and adaptation, that typically the public sector and philanthropy has tended to lead on. With the first, we might not need the second so much, but as it stands, we need both. So while it might not feel like for those of us on this panel that we're at the beginning of a journey, I wonder if maybe we are. So could you start us off sort of talking about, you know, how do we shift this mindset to nature positive when it comes to investing, and a couple of things we need to support that shift. And I appreciate this might be quite high level to start, but we'll ease into this topic and then go down into details.
Okay, thank you, Helen, and good afternoon to everyone. Well, we definitely need both those things. Just as June's UK Green Financing Framework talks about green finance as both the greening of the finance and financing the green, we've got to do the same for nature. We need to embed nature positive outcomes in mainstream finance, as well as investing in restoring nature on a much bigger scale than's been achieved by the pioneering work of philanthropists and niche investors in the public sector, as you say, Helen. I mean, Siddhartha Dasgupta has set out very well, you know, how we are ultimately sustained by nature in our economies, our livelihoods, and our well-being. And if we don't assign a true value to what it does for us, then the investment process results are never going to give us the sustainable outcomes we need. Anyway, you mentioned shifting mindsets. So the first shift that I think we need is to understand our dependencies on nature. This is the route, I think, for investors and businesses to understand the risks that nature's decline presents, and they are very real risks now, and the opportunities from investing in nature's restoration, and in a specific and contextual way, because the context is vital. Unlike climate change mitigation, nature's impacts and benefits are locally specific and need to be assessed with far more granularity than, for example, for carbon emissions. Disclosure and reporting on these dependencies would be a great start, I think, to stimulating financial markets to address nature. But for such disclosure to be effective, more clarity is also needed. And I guess that would be my second issue to shift mindsets. At present, you know, I do hear financial institutions beginning to talk about nature, which is great, but they talk about nature, biodiversity, natural capital, ecosystem services. They use these terms completely interchangeably. In fact, they're fundamentally different and require different financial responses and different business models. And I believe early action is dependent on us better understanding and communicating on these basics. So bear with me just to comment on those. Because once we all understand and use a common language, the case for investing in nature will be made easier, and the risk of further damage from well-intentioned early interventions will be reduced, because some of the early interventions aren't quite getting it right. So nature, or the natural world, is the totality of the non-human biosphere. Biodiversity is describing the variety of species present. And it's usually linked to a particular habitat. It might be an unaltered habitat, like a pristine rainforest, or it might be a much altered, heavily altered one, like the UK's countryside. But investment to improve biodiversity can aim to do either an increase in abundance of a particular species. That would be good for providing resilience to the population, reducing the risk of local or total extinction, or it can increase the variety of species to bring the ecosystem nearer to full capacity. It can be a combination of both, but care is needed, because you can actually destroy one by investing in the other. So you really do need to know what you're doing. And if you get it right, those investments will enhance the natural capital of the land or sea in question. And that will increase the flow of services which we benefit from. And it's those services where the revenue streams can come to give a return to the investors. I remember the Natural Capital Committee's reports in particular developed and explained the concept of natural capital being the stocks of nature and the ecosystem services, the flows from nature. And that's a good piece of work. And it's really important to understand these things, because ecosystem services are the ones which should provide the return on capital, which can make the proposition attractive for the markets. And some of these are more aligned to the public sector, like health, and some of the private sector, like, for example, food production. But what's always true is if the co-benefits are not recognised, as Partha Dasgupta has just said, if we actually take these things for free, if they're not recognised, they're not regulated, they're just overlooked and ignored, then the case for investment is either weakened or even destroyed, and the trust in this emerging market is going to be put at risk. So we do need more market intervention to cease the current situation, the so-called tragedy of the commons. But a last comment, with the mindset of a private equity investor or a venture capitalist, investing in nature does look a good bet. I mean, just look at it. It's operating way beyond its optimum level. It's delivering many benefits which are undervalued, and it's in universal demand. I mean, can you think of a sector that is as ripe for investment as that? But it isn't the prospect for a passive investor, because it's in a precarious state. It needs intensive management support. For too long, it's underpriced its products. It's been delivering goods for free, for heaven's sake. So a lot of work is required to firm up the market. And I hope we can talk more later on about how we can firm that market. But in the interest of time, I'll hand you back to you now, Helen.
Thank you so much, Peter, for setting us off in such an excited tone. It's fantastic. And some of the things you mentioned, disclosures, clarity, perhaps education in there, who's going to pay for maintenance, market intervention. Hopefully we'll cover those all off. So I really appreciate you sort of leading us on this. Robert, going to be coming to you as an investor who is already sold on this notion of biodiversity being a top priority and an opportunity, because BNP Paribas are really heavily engaged in nature. Can I ask you briefly to explain why you're convinced, and then as an investor or an asset owner, if you wanted to sort of shift assets, how challenging is it right now, and where also are the opportunities?
Thanks, Alan, and thank you also, Peter, for this great opening remarks. So yeah, I would really concur on the fact that so obviously we are in a deep biodiversity crisis. So on the why we're doing it, I think it's quite easy. I've recently seen an albatross picture feeding its baby albatross with plastic. So Simon, I think you saw that image too. So I think that's it. We don't need more numbers than that. We are in this deep crisis. So what can we do about it as investors? Well, I think there's this semantics, which is very important. Semantics, let's say, on the definitions on what's nature or what is ecosystem services. So there's lots of knowledge also for us investors, because we need to improve our understanding of all those terms. We've started this journey back in 2017, let's say, with like Capitals Coalition and all those great people that are really helping us to understand our dependencies, our impacts. And I think, that was really instrumental to us releasing our biodiversity roadmap, which we have launched this year, which is trying to address this big challenge of how to reallocate our capital to less harmful biodiversity, investments. But for that, you need to understand from a data perspective, from a disclosure perspective, from an engagement perspective, also from a walk in the talk perspective, let's say, because we are saying a lot of things to companies that you should do this, you should do that, but we should also, from an operations perspective, apply those principles. So that's basically the base in order to try to then set targets to reduce your harms that you're having on biodiversity, to understand the type of risk you're facing as an investor. Because obviously the risks which are, physical risk, like on the climate side, transition risk, but there are other risks, systemic risk is something that we are more and more talking about as an investor. But, when we say, what's the issue, what's our exposure to the savanization of the Amazon, how can we analyze that as an investor? We need new tools, new techniques, lots of data. So that's what we're trying to understand. So maybe just to talk more about the allocation topic, because that's the main topic of today. So how we allocate better our capital to less harmful investment on nature. Well, I think there's some, let's say, movement coming from the private equity space, which has been the traditional asset class on this topic, to more a gray zone towards more listed equities. So, which I think is a positive, because if you need to scale up, of course, you need to scale up big, which means listed equities, because this is a huge, obviously, asset class. So this is why we have launched the BNP Paribas Ecosystem Restoration Fund, which is a listed equity fund, which is targeting basically, companies which are trying to address these challenges through their processes, their product, their technology. So we have divided in three buckets: aquatic, terrestrial, and urban ecosystems, because you have some of those solution providers which are in the listed space regarding sustainable agriculture, alternative proteins, land-based agriculture, transportation, more like bicycle transportation type of, or urban or green buildings. This is exactly the type of companies whose activities can lower the harm or address or protect and restore the ecosystem. So I think it's important from an investment perspective to try to bring to your clients this type of funds. So it's a possibility today. You can do that, and also from a, let's say, more passive. There's another asset class, which is the ETF space, right? Which is also a huge massive investments. So also there, the direct link to more nature positive investment is not as easy, of course. But I think we have launched a blue economy ETF, for example, which is more a dependency ETF. So it's dependent to activities which are dependent on the good health of the oceans. So you have offshore wind, you have aquaculture, you have ecotourism. So it's more an indirect link, but still we have also built in some stewardship activities on this ETF, because an ETF relies on a public index. So the constituents of the index are public. So the companies in it are public. So what we're saying is that we are using our engagement activities with the constituent of the index in order to make them improve their practices. For example, we have started with seafood and also transport, so maritime transport companies, in order to say, hey, you are in this index. If you want to stay in this index, you better adopt the best practices, because this is of great importance to us. So that's another way to say, on the passive side of things can be done. Doesn't mean it's perfect, of course, but we are starting to seeing this movement.
Well, this is fascinating. Thank you. So it sounds like there is some opportunity in the listed equity space, and maybe we can dive into a bit of the fund later, because I'd be interested to see sort of how the sides and stuff. But Paul, I wanted to come over to you, maybe let's talk about the debt side. You worked on the UK Green Sovereign Bond we heard about earlier today, that has nature within its use of proceeds. We also heard that typically not seeing a lot of green bonds including proceeds for nature, use of proceeds for nature. The last figures I saw in the broader corporate green bond sector, I think only 5% of green bond issuance has allocation to nature from funds raised. It was quite old, that data, but I don't know if you've got more recent data. A bit more traction with sustainability linked loans. Where do you see the greatest opportunity for nature investments within debt? What type of issuer, what type of product?
Sure, yeah, thanks. So I think sovereigns are probably well placed to demonstrate, the role that they're playing and to kind of highlight aspects of government policy which will result in, better biodiversity, nature protection outcomes. So, if we think of the factors that drive deforestation or land conversion at the expense of biodiversity, I think sovereign issuers, regional government, local government are in a position to do something about that. Now, it can be very direct in terms of cost of land acquisition, for example, acquiring land that would otherwise be converted for agricultural use or something else. Acquiring land for conservation purposes and to preserve, the biodiversity characteristics. I think that's an obvious role that sovereigns can play. Outside of the sovereign space, there are corporates in certain industry sectors that are also heavily involved in the debate around land management and the best use of land and the economics of different land use options. Agricultural commodities are a good example, and finding ways to incentivize those companies to use set-asides or other kind of policy mechanisms to kind of preserve land that would otherwise be converted for agricultural use. Those initiatives that are undertaken by corporates to sort of balance their overall impact, and operate as a land steward to drive better outcomes from a biodiversity perspective. There are also opportunities, I think, for corporate issuers. Mining companies also quite heavily impacting potentially on the land. And again, the theme there is sort of land stewardship, or recognizing the role of the corporate once it acquires a mining concession, again, highlighting the decision or the policy approach being taken by that corporate to kind of balance different factors in the way they manage that concession. So I think there are opportunities there. It is a reasonably challenging category of green expenditure to link to your debt program for various reasons, which we can get into. The categories of expenditure that are easiest to understand tend to be more on the sort of renewable energy side, clean transportation, those sorts of things that are easier typically for investors to get their heads around. I think, as Robert will know, dealing with biodiversity related propositions is a more complex business, and you need an active manager that has the required skill set internally to be able to process biodiversity related propositions which are connected to green bond programs. And not every investor is in that position. So they are a bit more challenging, but in summary, I think sovereigns are probably best placed, and there are very direct things that can be done, and the cost of land acquisition is one. The cost of developing subsidy programs which are relevant to the agricultural sector and incentivizing farmers to play more of a stewardship role, and finding ways to sort of rebalance the economics of land use. The cost of those sorts of programs, I think, also something that a sovereign could explore usefully when thinking about linking its debt issuance program to biodiversity conservation objectives. And then lastly, certain corporates, particularly agricultural commodities and mining and other industries that are associated with land use and higher impacts on land. So that's in summary how we're seeing it. So I think there's a long way to go. As you say, the allocations to biodiversity type projects have been fairly modest so far. But I think as we gain comfort and investors develop the ability on their side to really process these kind of biodiversity linked propositions, I think we'll see more allocations going in favor of biodiversity type projects.
Well, there's certainly some great ideas there you've just put forward, so people are listening. And we'll come to sort of the challenges around metrics and things like that in a little bit. Simon, I'm keen to hear your views, following on from Paul. How do we get nature into mainstream finance, or the other way around? And any reflections specifically on Paul's comments, given your own research on sovereign debt and nature? And finally, if I can squeeze this in, just because we've talked about disclosure and given your role as advisor to the TNFD, would love to just hear whether you think that is going to support a shift in investments to this do no harm.
Sure, thanks very much indeed. And I'll try and build on some of the comments that have been made. So after decades of conservation finance languishing really on the side, I think we've reached an inflection point. And I don't think now is the time to ask why, but I think it's worth pointing out the intimate connection between nature-related risk and climate-related risk, which we haven't perhaps touched on directly. So building on Paul's points, Suriname is trying to put out a sovereign bond, with KPI-linked performance to deforestation, with a direct revenue flow linked to carbon credits. Yeah, and so there are all sorts of articulations of revenue flows from nature that relate across to the climate agenda, with many ifs and buts and metrics issues and additionality and leakage questions. But there's no doubt that part of the reason we've gone into an inflection point on nature is because of what's happening in the climate space. So it's as well to always remember the dynamic between the two. The task force on nature-related financial disclosure is, if you like, the younger cousin of TCFD, the task force on climate-related financial disclosure, but arguably with a difference. In fact, many differences. Not only is it dealing with nature rather than carbon, although the two are linked, but it's thinking about risk in a somewhat different way, a much broader perspective on nature dependency and impact, seeing those two different aspects as not necessarily always and everywhere material today, but in a sense pointing to, over time, how nature may become more material tomorrow. So nature impact today may seem something only of interest to impact investors or sovereigns, for example, but actually looked at through a dynamic transition risk pathway, one can imagine many aspects of nature impact becoming relevant to financial decision making. If the Environment Bill in the UK goes through Parliament as hoped for, a new mandatory due diligence on deforestation will come to exist for the non-financial corporate community, and that will trigger a whole ecosystem change in the way in which financial institutions need to think about, particularly their risk in relation to anti-money laundering, given that part of the deforestation is linked to illegal logging and illegal farming. So I think a whole bunch of different sort of dynamics, from sort of upside revenue streams linked to carbon to sort of downside liability issues related to AML, are going to begin to change the landscape, if you'll excuse the pun, as to how nature is relevant to some financial decision making. That said, the points about the complexity and the data and the fact that these are dependent assets, often not clearly privately owned assets, so there are all kinds of issues around legal entity and where liability sits, all, as Paul and Robert Alexander have pointed out, kind of adds complexity, and to Peter's point, kind of needs a whole lot of work to be done. Sovereign debt, well, why would one invest in a company without a balance sheet? The answer is one wouldn't. So why do we invest in sovereigns when we're not taking natural capital into account? The answer is we shouldn't, but we do. Yeah, and so in some countries that may seem less relevant, although as Professor Dasgupta points out, as do others, in fact, the entire economy is dependent on nature. It's not 10, 20, 30, 40%. It's absolutely everything, just in a variety of different and often indirect ways. But of course, some countries are particularly dependent and very visibly and directly dependent on nature, notably nature-related exporters or those that are driving domestic productivity and employment opportunities. Food is to nature what energy is to climate. And so the food sector is clearly the most important sector when we begin to think about how to deal with nature-related risks. And therein comes both upside opportunities. Robert Alexander has talked about alternate protein. We could dive into vertical farming. These are all ways of delinking food production systems from nature impacts. Clearly, there's the engaged variant of that, rewilding, regenerative agriculture, and so on. But there's no doubt that as nature becomes a more substantive risk in financial decision-making, asset allocation across the food system will begin to change, and arguably change rapidly. And I would make the observation that food is not really like energy at all. We talk blithely about disrupting the energy system and think that it's a great idea. But talking about disrupting the food system is a truly scary prospect. 450 million people, small farmers, work in the food system globally, and we're dependent obviously on the food system for food security. And so actually a rapid integration of nature risk into financial decision making that leads to dramatic asset reallocation over a short period of time could disrupt aspects of food security in ways that we really don't fancy at all. And that, of course, requires parallel and integrated policy measures to ensure that the system on which we defend for our food and the livelihood of many is held secure as we do the right thing, which is to bring in nature into the way in which financial systems work. Last point on sovereign debt, as you know, Helen, Finance for Biodiversity, now with a sort of growing set of other people, have been arguing that there is merit to moving beyond either use of proceeds green bonds as it relates to nature, or that sort of traditional sort of ad hoc one-off debt nature swaps. And we've been advocating and beginning to develop practice around KPI-linked sovereign debt, where nature and climate KPIs are being used to build pay-for-performance models. I think it's an early stage in that process, not only because of all of the KPI issues associated with either nature or climate, but because of very mixed experience in sovereign debt markets in KPI debt of any kind at all. Yeah, with many differing views as to their merit and their worth, and are they inefficient because they're hybrid instruments and so on and so forth. But we do see, in the context of the sort of green debt relief discussion that's beginning to emerge in the context of the COVID crisis, a growing number of individual examples of KPI-linked sovereign debt instruments beginning to be sort of offered onto the market, in the first instance only to sovereign creditors interested in buying down public goods effectively, either nature or climate benefits, but clearly with an interest to see at what point that can, if you like, train the market more effectively to think about nature and climate related risks in a sense. So KPI clearly is trying to overcome market failure in many ways, where the market is not taking it into account. And gradually, of course, one would expect the market infrastructure to begin to adjust to what's actually needed. And we see now work going on in looking at where nature sits into sovereign credit ratings. We see work going on where nature and climate fits into debt sustainability assessments. So sort of next gen developments of the way market infrastructure begins to take account of these different factors. Back to you.
Wow, fantastic. Thank you. Thanks, Simon. And there's a lot there. I feel like we're sort of gathering all these amazing ideas from everyone, and we'll sort of try and dive into them in a bit. Tashita, to round us off on all of these amazing ideas, and thank you for waiting so patiently. I wonder if we can sort of throw something else into the mix. We've talked here about mainstream finance, and I kind of wanted to ask you about this sort of that second part of the equation I mentioned earlier, which actually there's probably a bit of a debate if they are separate. There's shifting global flows and then investing specifically in restoration. Your recent report released by the Green Purposes Company is entitled MBS, an Emerging Institutional Asset Class. And it shows that there's an opportunity out there clearly for investors, although small. What do you think we need to get investors to the table for these deals? We've heard talk about KPIs, so I'd just love to hear your thoughts.
Sure, thanks, Helen. So as you said, we recently commissioned a market review of nature-based solutions to understand how these projects are being financed in various parts of the world. We already know that the financing gap for nature is at least 700 billion per year. And so we were quite keen to focus on case studies where financing relied on repayable and private capital, so not just philanthropic or concessionary capital. And these case studies involved nature-based projects ranging from sustainable forestry to protection of species and habitats. So what we found is that there is a huge amount of private capital available, which is just looking for projects with viable business models to finance. So what these investors are really searching for is a strong pipeline of investable projects. And our report made a number of recommendations for both policymakers as well as investors to accelerate investment into nature and how to move this asset class, which is currently on the fringes, into the mainstream. And so what needs to happen now is to get some early transactions done, as that would demonstrate that there are reliable revenue streams from these projects which can be financed. So actually that is really now key. Most transactions to date, as you pointed out, have been quite small, so somewhere around the million mark or even less. And therefore they're quite small for mainstream institutional investors. But there is an opportunity here to aggregate these small deals and offer these up as a viable investment opportunity. I mean, initially you could have large landowners, whether they are private or public, or even NGOs who have access to large land banks, can act as sponsors of projects which can then be financed, just so that we can establish some precedents. Knowledge and learnings from these structures need to be shared with the financing community. And these deals will also enable us to test the metrics for measuring outcomes. So basically, once you've got a few deals closed, you would have the benchmarks and the templates created, and then the market can evolve from there. And talking about the UK, because there's been a lot of good discussion earlier on in the conference, the opportunity is very much there in the UK. The pipeline of deals that can be immediately financed is small, so there's no getting away from that. But with funds being made available by the government, such as the Natural Environment Investment Readiness Fund, which is helping developers and companies come up with viable investable structures, with that happening, no doubt there will be a raft of projects that will get financed over the next few months. So there's also the opportunity now to start to stack various revenue streams from sale of carbon credits, biodiversity credits, etc., and so that these projects can then finally become bankable. And so, as has already been mentioned, the upcoming Environment Bill in the UK, they will develop a formal mechanism to calculate things like biodiversity net gain, and consequently a price will invariably develop. And so what is really quite encouraging is that in the last week alone, you've got a partnership announced between National Parks UK and a group of corporate funders, where they would make funding available for nature restoration and enhancing local biodiversity. I understand that the first project will be restoration of damaged peatland, with many more projects to follow. And the total funding commitment, I believe, is around £240 million. So if we can get some of these small and big transactions come to market and be financed with a range of investors, so not just NGOs or family offices, but also banks and specialist funds, we could see the emergence of a thriving market. I think we should never forget that even the green bond market started with only a few issuances and now enjoys huge investor interest. So personally, I'm quite confident that in the next year, we will see many more financings being announced in the UK, and the market will finally take off.
Thanks, Tashita. It's really interesting, and it's exciting actually to sort of listen to you all. You really sense that there is an opportunity here. As I think a couple of years ago, people kind of scratching their heads going, it's never going to happen. Like, how can you possibly embed nature within finance? It's just too complex. And it obviously is starting to happen, and has some great ideas of how it can happen more here. It'd be great to start to unpack some of these points raised. I encourage the audience to send in a question. I'm seeing one here already that I'm going to come to in a moment. And please, to our panelists, chime in. I'd love this to be a bit more of a conversational part before we sort of really dive into some of these questions from the audience. Tashita, can I just stay with you here? You were an early investor in the green transition to renewable energy in the UK through the Green Investment Bank. What got you comfortable, and do you see any learnings we can replicate for nature? I'm sort of keen to see how we can start building investor confidence, and in this part sort of talk about some of the mechanisms and the policies and standards and metrics we need to get things moving.
Yeah, so the UK really led the market, particularly for offshore wind energy generation in the world. Initially, you had the renewable obligation certificates, the ROCs, And then, of course, with the successful leasing rounds by the Crown Estate, the market for large-scale development in the UK attracted significant institutional investment. So large developers and large institutional and sovereign investors put money into the early stages of this market. And the scale of the policy intervention at that time from the government was really quite ambitious, and the project developers responded accordingly. So the ROCs, the feed-in tariff schemes, enabled investors to get comfortable with the market as well as the technology risk. And so now today we have renewable energy in the UK as very mainstream with very, very competitive pricing. So I think that the UK also is particularly well poised to jumpstart the market for investing in nature here. I mean, you know, the Green Gilts already have a Green Plus aspiration with a focus on biodiversity as well. The Environment Bill is a good start, with property developers now being asked to purchase offsets related to biodiversity net gain. I already talked about DEFRA's Investment Readiness Fund helping the first round of projects to create these business plans. But of course, the scale and ambition could be greater. It is easy to measure energy production in terms of megawatt hours. So renewable energy was more straightforward. It is less straightforward to measure and value protection and restoration of nature, and several people have touched on this issue. But then you also, in addition to measuring, you also have to now come up with pricing models, so financial models that need to be developed to price nature. And earlier in the first panel, in this conference, there was a discussion around how to price some of these things. And I think the representative from the World Bank talked about some work now going into developing financial models that can somehow send some price signals to appropriately price things like biodiversity, drawing very much from what we have seen in the carbon markets. So policy interventions could help us also financially de-risk, like they did in renewable energy, for at least the first round of nature-based projects. So obviously more work needs to be done to standardize metrics. So as we start to measure, pricing will emerge and these projects will get financed.
Brilliant. Thank you. Thank you. Peter, I wonder if Simon's got his hand up. Yes, Simon, jump in.
I was just going to sort of complement Tushita's point just with a couple of kind of market observations. So, I think the analogy to clean energy is really helpful. So, very much Tushita's point, but I also think it's quite limited. This shirt has a QR code on it. You can see how much water was used in its production, and you can see whether or not it was used legally. Yeah, that nature is embodied in many other things that we trade, notably property, and that isn't the same as the way in which we think about clean energy, and isn't the way in which we've developed business models that derive revenue streams from nature trading. So I think the plus side is that yes, one can treat nature as infrastructure, which is essentially Tushita's point, and I think that's absolutely right. But actually, because nature is embodied in everything we trade, I think the complexity and diversity of nature markets that emerge over the coming few years will be much more interesting, if you like, and much more varied.
Yeah, good point. Thank you. Thanks for chiming in there. Robert, I'd love to hear your thoughts.
Yeah, I wanted to echo the two previous panelists, because I think, the seek for data will always be there, right? We will have better and better data. We have launched a partnership with CDP. We are funding their CDP Biodiversity questionnaire. That's going to be super great for everybody, because, we need corporates report in a homogeneous way. There's TNFD, of course. We have launched with other investor initiative to have biodiversity impact data. So now we have a data provider called Iceberg Data Lab. There are others, and we will be able to report on our biodiversity impact. We're doing our biodiversity footprint. So, on this question, is there data and what should we do with it? I think we have data today, But so there are, similarities with climate that, using this data, we can influence our decisions. But still, we will be in the trade of business, because now we will have the, CO2 impact. We will have a abundance, let's say a negative impact on biodiversity. We'll have multiple metrics. And then for the portfolio manager, who will have to put his money in a company, for example, he will have to decide, and sometimes he can minimize carbon emissions, but it's not going to be the same, or it would contradict the biodiversity positive impact, even though today there's still no, for listed equities, for example, way to account for positive impact on biodiversity. I mean, it's difficult, but it's just to send the signal that, it's not going to be very easy, and it will require a lot of expertise and time and case-by-case analysis to take into account all this data to really improve your decision making. And it's not going to be as easy as minimizing carbon emissions, which is you just take the CO2 and that's it. With biodiversity, we'll have abundance measures, species extinction risk measure, ecosystem, like at the biome level measures. So, linked to the local aspect of biodiversity. So just wanted to also give that that lens on the complexity for decision making.
No, I appreciate that. And there's a question here about, the complexity. Can long-term biodiversity impacts be measured, modeled and projected? But Peter, I see you've got your hand up and would love to hear your views.
I just wanted to, thanks, Helen, pick up really on what Toshita and Robert was saying there about the sort of market design, and pick up too from what Simon was saying. I think there is quite a lot we can learn. I mean, we know what we need to design. It's a high integrity market, and we do know how to do that. We've done a lot of markets before, which we can learn from, not least the carbon market. But I just want to inject a sense of urgency here. We don't have decades to get this right. It took a long time with carbon markets to get it right. We've got to get it right first time. And in that sense, some of the parallels of the early decarbonisation of UK's energy in terms of the ambition of the policies, I think, is what we need. And I am concerned that we can't, just to quote one of the panelists, we can't really wait for the market to gradually adjust. I think that will be too late. We need actually to stimulate it to move in a more dramatic way. And there are three things in the market for me. You've got to have the design right. That's around long, loud and legal policy goals. They've got to be underpinned by a policy framework which is robust, it's enduring, and that will provide the incentives for innovators. You need regulators who can give an even playing field, and you need them to set the market boundaries, and you need the institutional architecture that's adequately funded, it's competent, and it's enduring. On the governance side of the market, you've got to do that in a way to design to promote trust and integrity. That is fundamentally around standards, which is obviously one of my hobby horses. But you need those standards because they underpin accreditation, they underpin monitoring and verification, and most of all, the appropriateness of the data which the markets are transacting in. As several of the speakers have said, there's a lot of data out there at the moment. The problem is we need to be much better at communicating that and using it in a way which can actually be applied in the financial world. At the moment, it's not very user-friendly, if you like. And if you do that, you also promote disclosure and voluntary commitments from corporates, and that'll enhance the pace that the regulatory base, which effectively is just sort of your bottom line of where the pace that needs to go. And then third part of the market is the operation of it. And Toshita's talked about the need to aggregate up projects. This is really important. Actually, within nature investment, a lot of the projects are actually going to be inevitably quite small scale because they're dealing with this granularity of nature, which isn't as international, if you like, as the climate campaign. But it's also the market infrastructure which defines the market rules, contracting, taxation, which is one lever that governments have, and also in terms of these local-based delivery mechanisms to actually do the things on the ground. Now, having said all of that, I would take one thing from history. I would take the renewables obligation was very effective. So what about a policy recommendation for a nature positive obligation? Handed out to sectors, just like the renewables obligation was handed out to the energy markets. That clear signpost, I think, could be an enduring driver to bring forward investment and arrest the decline in nature. You know, it's something that we need, which is sort of really clear and enduring, but gives that strong signpost. I feel that other methods, we might just be lagging a bit behind, and we need to bring home this urgency. We talk about, 1.6 planets or 3 planets. The Environment Audit Committee here in the UK just published something showing the biodiversity imprint of the UK. These actually are overreaching. We have risks of tipping points. We have risks of permanent decline. We must move as fast as we possibly can. Thank you.
Thanks, Peter. It's difficult, isn't it? Because I'm hearing that it's incredibly urgent, but we must be very considered and not rush things through, because we could end up with a disaster. But still, we have to move quickly. There's a lot of parts that we need to tap into, whether it's pipeline development and standard development and data, and we all need it in one place, and we need to understand our risks and the disclosure. So it's like, oh my goodness, how do we keep all this together? And Simon, I see your hand up, and I'd love to come to you, but Paul, I want to also I'm going to come to you in a moment as well. So Simon, please.
I'm going to be very brief, which is, I think the challenge that Peter puts on the table, of course, is right. And it's magnified by the fact that nature is local, which tends to drive us into situationally specific solutions. And yet we know that you can't reach scale in that way. The danger is that we try to emulate some sort of biodiversity offset markets, not recognizing, of course, that a litre of water in Amsterdam is anyway totally different from a litre of water in Kenya. So you can't trade in the same way. And so the really interesting question really we should focus on, particularly given that this is an ONFIF platform, is what does one do in the financial system to reach the kind of scale we want? Because if this was a food discussion, we could talk about food systems, but it's not. It's a financial system discussion. And so my bet is not the solution, but certainly that a strong push with regulatory and data and standardization aspects to integrate nature risk, both through central banking interventions and through mandatory reporting interventions, is definitely not the whole solution, but it's an upstream approach that has impacts across the nature system in multiple ways, sometimes unexpected, possibly with some problematic consequences, but upstream at the heart of the way in which private finance works. It's not the only answer, but I'd love to get a sense from the other panelists as to what those scaled interventions really look like in practice.
Thanks, Simon. And it's great that you mentioned this, because it's actual solution, and now it's actually possible to see that this could actually happen. So Paul, you're a bit on the spot, because I just flagged up that I'm coming to you next, and now Simon's put out this question. So I was wondering if we'll come to you, and what are your initial thoughts?
Yeah, sure. So, I think certainly we've seen the ESG debt capital market scale quite quickly, but worth saying that, we're probably still in single-digit percentages when it comes to the overall volumes of debt being issued globally every year. Only single-digit percentage is ESG labeled in some way. Now, in the EU, that's grown quite quickly. In fact, I read a stat recently that 25% of the issuance, I think, in a given month was actually issued as ESG debt. So it's scaling quickly, but part of the reason it's scaling quickly is because at the moment it sort of works for the market. And the reality is, I think there is an appetite to let the market grow and scale, and then start, tightening up in a way. And I think the EU taxonomy and things like that are the first step back towards tighter definitions of what constitutes green uses of proceeds. The reality is that the tighter you define, the more difficult the market finds it to actually operate. And these definitions and extra information creates friction in the system, which typically puts a dampener on growth. So I'm just kind of describing the water here that we're all drowning in, but this is the reality of the way the market works. Commoditization, leads to scale, and the more the pieces can be made to fit into every box, the easier it is for the market to sort of suck them up and deploy them in the way that the market finds most economically advantageous. But the reality is, the real economy, and particularly biodiversity and similar themes, defy any attempt to put them in boxes. So if there's an answer to the question, I guess it would be a couple of ideas. Carbon pricing, things of that nature, I think are very useful tools. And also common definitions leading to and it sounds terrible, but a commoditization of nature, a way that allows the market to price the value of nature, because without that, I think it's very difficult to scale anything. And we'll always be in a position where, nature investing and biodiversity themed finance, remains sort of niche, and the sort of impact investing end of the market. The reality is, for the machinery of the market to really work at scale, everything needs to be commoditized, and the shapes need to fit in all the boxes. And that's where we need something akin to a carbon credit, a nature credit, or something that can be traded in a way which means that the market can scale.
Thank you, Paul. Well, I'd love to get other thoughts on a nature credit. Does anyone give me a wave? Tishita, great.
Yeah, I fully agree with Paul. I think it sounds harsh to refer to commoditization of the biodiversity market, but if you want to achieve scale, if you want to get institutional investment in, you will have to start somewhere. And I sort of before we even get to the commoditization, I think and worries too much about having the perfect standards or the perfect taxonomy. I think it's very important to actually get things off the ground and get some early transactions closed. And I think that is really the key, because there's a lot of discussion, a lot of reports, we've ourselves commissioned a lot of reports, but now I think the time has come to actually get some transactions done so that some of these business models, some of these pricing models can be tested and challenged. And that's all part of a healthy evolution of the market. So I think even if the transactions are small, and even if they are not purely commercial, and they are executed in partnership, I think it's important to get some of these done. And as regards the metrics or the standards, I think we can work with something a little bit simple, but there might be early missteps, but that's how we will learn and grow from there. So I think that's really critical. I think the fact that the UK government or the Treasury is now looking to have this report out in 2 years' time to discuss or to demonstrate how they are including biodiversity metrics and their performance against those user proceeds into their publications. I think that is a good step forward. It's all part of the transparency and disclosure. The fact that we will have TNFD down the road, I think that is also a step in the right direction. So I think it may be small steps, but at least we are now getting things off the ground, and I think that itself is key.
Brilliant, thank you. Yeah, I'm completely with you on the pipeline development and just getting these examples out there so we can start understanding what works, what doesn't work, what should the public sector pick up, what can the private sector take. Peter, you have your hand up.
Just to reinforce a little bit, absolutely agree with what Tishita's saying. Learning by doing is what we have to do. But we haven't really cracked this nut of the fact that there needs to be a visible return for the financial markets to actually move in. The irony is we've got plenty of money. What we don't have is enough projects. And that's where I think we do need some sort of stimulation. But I just wanted to say something about the metric side as well. We're not starting with a blank canvas. I think this is one of the things we've got to connect the financial community with some of the work that's already been done by ecologists and the like. We've got the IUCN Global Standard for Nature-Based Solutions. We've got the UNEP's World Conservation Monitoring Center Multidimensional Biodiversity Index. That MBI is just, we've had the Human Development Index, which has been widely used by multilaterals and by aid agencies as a measure of human development at a sovereign level. This is an equivalent for biodiversity and could be used, I think, very effectively straight away. China has its own cross-ecosystem product system as well. So TNFD, I think, yeah, we've got a lot of hope on in terms of that, and many of us are going to be putting a shoulder to the wheel there. But I think it's really important that we don't wait and end up with perfection being the enemy of the good here. There's a lot of people who want to do some good, and through learning that, to be honest, what's going on at the moment, it'd be very hard pushed to make it worse. But if we don't make it quite as good as we could have done, but we've learned a lot on the way, we'll get a lot more done in the long term.
Yeah, thank you. Thanks, Peter. Simon, your thoughts?
Yeah, I mean, I think we are all painfully agreeing. Probably we should find reasons for disagreeing. But I'd add just lay a couple of points in. The first is, it's taken us 20 years to figure out how to leverage the judicial system and the financial regulatory system in relation to carbon. Yeah, and it's taking us 5.5 minutes to figure out how to do that for nature. Yeah, and there are many, many more legal and liability levers in the nature space than there are in the climate space. Now, that's not music to the ears of the financial community, but it is another way of valorizing nature for the business community, which is to create a raft of different liabilities. You know, I've already mentioned the Environment Bill. There are equivalent measures emerging across Europe and elsewhere, and we're seeing quite quickly similar initiatives emerging in some nature-intensive economies, such as Brazil. So firstly, let's not discard that valorization isn't always about putting an upside price. Sometimes it's about a downside liability. And from a nature point of view, that's something we shouldn't ignore. And then the second thing is, I wanted to come back. I can't remember whether it was Paul or Tushita or somebody else who talked about feed-in tariffs. You know, we've just done a big piece of work on food and finance. And the question we were asking was quite similar. We asked, you know, what is the feed-in tariff equivalent in the nature space? And almost certainly it has to be in the food area. Yeah. And then what aspect of food might that be in? You know, would it be in, for example, CapEx intensive food systems like alternate protein and vertical farming, because that's a much more standardized food production system and can be measured very, very accurately in terms of its climate and nature relationship? Or is it something else? In other words, I think Tushita and others are right. We can't, you know, sort of crowd out the good for search for the perfect, but I do wonder whether there are some of these very scalable offtake agreements or comparable mechanisms in the nature space. Are they necessarily linked to food, or might they be linked to other factors? And I'd be very interested as to whether there is any thinking of that from other members of the panel.
Oh, that is a wonderful baton to pass on. We have like 3 minutes, and I'm going to say 2 because I want to do a handoff. So Tushita, feel free to go, but just have in mind we've got 90 seconds.
I'm going to keep it very brief. I think Simon's question about whether we should have some sort of offtake arrangements or subsidies underpinning a certain sector. I would say that we should be sector agnostic. I mean, so not necessarily food or alternative proteins, but yes, there is, I think, merits to have some sort of an equivalent of a feed-in tariff or some sort of de-risking of the early investments in nature.
Thank you. Yes, and we didn't even come to de-risking and concessionary capital, which was something I was hoping we would get to today. There's just so much to talk about. So literally we've got 2 minutes, and we didn't get to cover it all. We covered a lot, perhaps not in as much detail as what I think we're all really passionate to cover. But okay, now it's down to 1 minute. Anyone sort of, what haven't we talked about today that we should be talking about more often? Give me a wave, Robert.
Yeah, maybe one thing on the support, for example, from investors for strong policy making and strong also outcomes. For example, like COP15, which has started its first version this week. So just for the audience, you know, there's 10,000 billion of assets under management who signed like expectations, investor expectations, to say we need a strong outcome at COP15. So that's also important to say, because, you know, on the climate side, you know, 2015, the COP21 was also a success because the private sector was there. So yeah, it's just to say that on the nature side of things, we need also that support. So it's also a little bit a call to action.
I love that. Ending with a call to action. Paul, if you can get it done in 5 words.
Yeah, I would say technology's got a role to play. We're seeing a lot of promising technologies coming through, satellite technology. There's also a technique which uses what they call environmental DNA, and that can be used to monitor biodiversity. All of these things, I think, are going to be part of the solutions to come.
Brilliant. Thank you. Thanks for being so quick. So that's it. That's all we have time for. Thank you so much to our panelists today. It's been a real pleasure, and thank you to our audience. Please don't go away, because coming up next, we have Clive Forward, Deputy CEO and Managing Editor of ONFIF, speaking with Jean Bossinard, Head of the Secretariat for the NGFS. Thank you again to everyone, and enjoy the rest of your afternoon.
Thanks very much.
Thanks.
Thank you.
Well done, Helen. Bye.